when I put those together, I think this is potentially the largest monetary tightening in all history.
It is.
How are you thinking
It is
about it?
very strong. And then, so I was talking to, I was interviewing David Rosenberg a few weeks ago, and I got getting a lot of good feedback from this. And generally, I'm somewhat aligned with him on. I tend to be at least partially aligned with him, not always perfectly, but we tend to think a lot similar. I followed him for years, and he's kind of giving it. He thinks recession, and that was before the negative print on Q1 GDP, and he thought recession was imminent. But he was giving, I think, like a 20% chance of soft landing. And honestly, I see next to zero chance of soft landing.
Yeah, I don't see components that allow that. If we take into account what's happening in China and Europe as well, the probability of a soft landing has got to be close to zero now.
Well, I'm thinking, paradoxically, I think that there is almost like a binary outcome. And the reason is because Fed took such a inflation fighting stand, which is also with a caveat, some people think that Fed is way behind the curve, right? And some people think that Fed is still blowing bubbles because they're not raising rates at 200 basis points per meeting, right? I kind of think that is somewhat ridiculous view, but I have been ridiculously wrong in the past before myself, right?
So my view on that is the markets raise rates without the Fed.
Yeah, well, they
did their job.
The Fed is doing their part because quantitative tightening is very significant too, right? And the stock market tightening is very significant. I feel that there is almost like a chance that if I'm wrong about inflation, then we might have a complete inflationary meltdown, right? And inflation spins out. I would give or maybe like economy somehow magically keeps running hot on this inflation and the rates, negative real rates. There, you have to assign some probability to that scenario. That's not what I see because I'm seeing all this tightening taking a bite and getting traction. But I see a possibility of that. What I don't think is going to happen is soft landing because the Fed is fighting it so hard that sooner or later they kind of committed to break things to get it down. So wherever that breaking point is, it's not going to be a soft landing.
No, that's right. When I look forward and think, okay, what is the probability that I might be wrong further down the line? And the outcome for that is I don't really know what this Chinese lockdown situation does to supply chains, and does that keep this rate of inflation higher for a period of time? And obviously it would be further geopolitical unrest, let's say China, Taiwan. Those are the two things that are on my horizon that those are the things that concern me if I was to attach a small probability to that framework being wrong.
Yes, well, I wonder, all of those, we're kind of living in this different paradigm, right? A few years ago, the notion was that whatever happens, it causes rates to go down. Now and turns out that yes, but up to a point, right?
That's an interesting point.
Right? Now
maybe that's
kind of got this mindset that whatever happens is going to cause rates to go up. In the past, at the beginning of the war would cause rates to go down, not up.
That's an interesting thought. I had not thought about that maybe that whole the risks are to the upside in rates as opposed to the downside.
People always think okay, if China invades Taiwan, rates are going to go up further. But it actually doesn't have to be that way, right?
No.
That is the mindset. And there is a little bit of that end cycle trap that rates are kind of trapped, right? Because we're having high inflation as we did in 2008. We had very high inflation prints. The high inflation prints in 2000, right? Not as high as now, but they were high.
I'm holding another thesis in my head, a potential thesis, which is that rates just go sideways for the next decade. So, we've got the demographic pressures and all the stuff that you and I are aware of. And maybe we have broken that channel, but it doesn't mean that rates go up. It just means that they slop around in a range between 0 and 3% or 1 and 3%.
So possibly, but that would have to be an environment of much steeper yield curve because the front end rates are going to 0, which is possible, much steeper yield curve. But I just don't think, I have hard time imagining stability in this environment because the tightening is just too rapid. And the question is, when at what juncture inflation will roll over? I think it will roll over very soon. But the moment it starts rolling over, that would also mean that real rates are going to start going very rapidly higher. and that will be in itself created other leg of tightening the real rates, which we're already seeing in market pricing higher real rates. But that will, when it will actually become like the actual loans, the real rates will go positive. That will be a.
So picking through what you're saying here, what happened 2 years ago was caused what's happening now. What's happening now is causing a high probability for a pretty severe recession in 2 years' time.
Yes, and I fully expect negative inflation in 2023.
So therefore, we should be looking for the cycle top in all of this, because it takes time. I think it's actually going to fall faster than expected. All of the growth numbers, all the forward-looking ISM numbers, all of the stuff that I do, they're falling apart at an incredible rate.
Well, and we're already in recession. We had negative GDP growth. And then actually, Noah Smith pointed out on Twitter really well that people started mumbling about imports, but that's actually not the correct math. Imports do not subtract the GDP growth. That's a urban legend. So we are in negative GDP growth for whatever you like it or not, right? It could be a one-time thing, but possibly now they're saying second quarter of negative GDP growth. And maybe, okay, some people might say like, yeah, that was just a little bit of this war-caused recession, it's behind us. But this is an interesting monetary experiment, because we usually, when we are in recession, we're actually easing monetary conditions. This is kind of like an unusual situation that we may be in a short-term recession, which is perceived as short-term recession, but we're actually tightening monetary conditions as we're in it. Last time we did it, we got Great Depression, I think. Actually, I don't know, but there might have been times in the 70s when Fed was forced to tighten into recession as well. So I might be a little cavalier about this, but I think that was the event. I don't know the history of times before I was on the market as precisely as when I was on the markets, but I think in the 30s, Federal Reserve was actually tightening rates into recession and possibly contributed to the Great Depression, right? So what is happening now is very interesting. We're in recession and we're tightening.
Okay, let's think of and again, none of us have a crystal ball here, but the expectation feels like the second half of the year, suddenly the story is going to change quite fast. People are going to start focusing on weaker growth and inflation coming off, which is what we saw in 2008, right? Because inflation was 6.5% or whatever it was, and growth started falling fast, and everybody started ignoring inflation. Do you think we're near then? What's the time horizon you think of the change, the tipping point here?
I think it's pretty soon, but I am reluctant to fully wage my portfolio on the time horizon, as we discussed earlier. It's a little safer for me to say, well, I think by the end of 2023 we should have changes. But I think my heart is in being with David Rosenberg on the fact that the rollover will happen much sooner than people think, because it could be very rapid. And paradoxically, high inflation numbers are only increasing my bullish bonds view right now, because what's happening is it gives the Fed the ammunition to kind of do those couple of hikes that they planned. And they so bound themselves right now to this extra 100 basis points that they almost have to go ahead with those regardless of data. So they kind of program themselves to hike rates twice in the next 2.5 months.
Interesting. I spoke to, as part of this whole series exploring this topic, I spoke to two interesting people, Pierre Andorand, who's the oil trader, and Dwight Anderson. Do you know Dwight?
No. I have not talked to him, but I know him. I've ran into him on media.
They were pretty clear that, we're getting very close to demand destruction, because I talked about, there's a lot of people's view that Europe is screwed forever here because of cutting off the Russian oil and gas and food and stuff. And their view was, yes, but demand destruction. They think they're even going to throttle power use. So one of the things I'm looking at is oil rolling over. I kind of feel like oil going up is a tightening of conditions generally globally, but I'm kind of looking for that as the final signal. I thought it was going to go yesterday, but didn't. It rebounded again. What signals, what final signals are you looking for?
Well, oil is very interesting, and I've been talking about this oil. First of all, oil run up has been in the past a really excellent indicator of approaching recession, one of multiple a recession, like, and it's always like a little ahead of recession, oil peaks out, and then it starts actually going down once recession sets on. So that's an interesting signal. However, I'm kind of like you. I actually was talking about this. I wouldn't rule out $40 oil in a year or two, because like everybody else tells me the stories about why oil has to go up, like that there is no ability, like the structural problems which are created by lack of investment and ESG and whatever, and they're all valid stories. But I always say there is a story and there is a location. So when you create a good story for something to go up, it goes up. And then at some point it doesn't go up, even if the story is still good. As we found out recently with some companies that looked pretty solid and kept going up, and then all of a sudden we're having a bloodbath everywhere. And stock, I think we're having bloodbath on some names. I'm not a stock picker, but I really feel like there are some things that are going up even though that's going down now when the story is still good. There's just more sellers than buyers. That's another story, right, for you. Same thing with oil. At some point, there will be a story with more sellers than buyers.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion. But who's right, who's wrong? As co-founder of Real Vision, I've got my own view, but maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen my experts for this 2-week journey of discovery in global recession. Is everyone wrong? I've chosen people like Peter Zeihan to talk to him about geopolitics, David Rosenberg about the economy, and Pierre Andran, the world's most famous energy trader, about how to navigate the oil markets and where it's all going. This starts on May the 2nd, and I'm going to learn so much about what really is going on and how to best navigate it. Yes, not everybody's going to be saying the same thing, but it's going to allow me to piece together an investment framework to navigate these complicated times. Now, normally we'd give you a 7-day trial for $1, but because this is so important for all of you, and I think it's one of the most important pieces of content we've ever done, we're extending that free trial for 2 weeks for $1. So you get the entire campaign of all of these great minds. And it's only $1 for all of this. So just go to realvision.com/global recession to find out more and join me as I try and figure out what the hell's going on.